Chapter 17. Investing in Mutual Funds, Commodities, Real Estate, and Collectibles. In addition to stocks and bonds, you can also consider investing in mutual funds. A mutual fund serves as a convenient way for an investor to have a diversified portfolio of investments in just about any investable asset. It's a portfolio of securities consisting of one type of security or a combination of several different types. A mutual fund also provides stock and bond issuers with a mass market. Rather than selling shares to investors individually, issuers can more easily find a market for their shares in mutual funds. Mutual funds are structured in one of three ways. The first is closed-ended funds, which have a limited number of shares issued. So once all the shares have been issued, that fund is closed, and a new investor can only buy shares from an existing investor. Open-ended funds are when investors buy shares directly from the fund and redeem or sell shares back to the fund. Thus, there's an unlimited number of shares available. Exchange-traded funds, or ETFs, are structured like closed-end funds but are traded like stocks. So shares are traded and priced continuously throughout the day's trading session rather than once per day at the end of trading. With open-end funds, the price of a share is its net asset value, or NAV, or the market value of each share as determined by the fund's assets and liabilities and the number of shares that exist. To calculate the NAV, you take the market value of fund securities minus the fund liabilities, and then take that number and divide it by the number of shares outstanding. The NAV is the price that the fund will pay you when you redeem your shares, so it's a gauge of the share's value. Shares of closed-end funds and exchange-traded funds are bought and sold on exchanges, much like shares of stock. You'd go through a broker to make those transactions. Shares of open-end funds may be bought and sold directly from the fund sponsor, a mutual fund company, or an investment manager like Fidelity or Vanguard. Some of the types of mutual funds that you can invest in are funds of funds. So these are mutual funds that own shares in other mutual funds rather than in specific securities. There's lifestyle funds, so these are the funds of stocks and bonds that manage portfolio risk based on age or the time horizon for liquidity needs. Lifestyle funds are used primarily for retirement. Leveraged funds are funds that invest both investors' money and money that the fund borrows to augment the investable assets and thus potential returns. These are riskier because they use borrowing. Inverse funds aim to increase in value when the market declines, to be countercyclical to index funds, which aim to increase value when the market rises. These are also known as bear funds. Mutual funds have different fees and returns, so all funds must disclose their fee to potential investors. A load fund charges a sales commission on each share purchased. The sales charge, also known as a front-end load, is a percentage of the purchase price. A no-load fund does not charge a sales commission because shares may be purchased directly from the fund or through a discount broker. Now, a fund may charge an annual 12B-1 fee or distribution fee, also calculated as not more than 1% per year of the fund's asset value. So some mutual funds charge other extra fees as well, passing on fund expenses to shareholders. So you should consider the fee structure and rate when choosing mutual funds. And this can be done through calculations of the expense ratio. This is the total annual fees expressed as a percentage of your total investment. Now, the expense ratio averages about 0.55% for all mutual funds, but it may be more than 2% of your investment value. So when choosing a fund, you should be aware of all the charges, whether it's annual or ongoing, because that can affect your investment return. So let's take a look at an example. Here's our original investment of $5,000 I have set aside to put into a mutual fund. There is a load. This is a load fund, so there's a sales commission of 5%, so that'll be $250. So once I subtract the $250 or the commission from my $5,000, that leaves me with $4,750 left to invest. From there, we can see that we have a 5% return of $237.50 on that net investment. And when I add those two together, my end of year assets will be $4,987.50. Now, I do have to subtract 4 expenses, so I will subtract $112.22 from my end of year assets, which leaves me with an ending investment of $4,875.28. So you can see if I take my net investment, subtract my ending investment, I get 125.28, or a net percentage return of 2.5%. Another way to look at that is if we take a look at our return and our expenses and subtract those two, that is our net return right here. And then what we'll do is we'll take the net return and divide it by our ending investment. So let's say that's our X. We'll take our C divided by X, and that gives us a net percentage return of 2.5%. Some other things to think about regarding fees and returns is that income may come from interest distribution if the fund invests in bonds or interest-producing assets, or as dividend distributions if the fund invests in stocks. Now, mutual funds buy and sell or turn over the fund assets. The turnover ratio is the percentage of fund assets turned over or replaced in the past year, a measure of the fund's trading activity. Turnover can create capital gains or losses. So usually once a year, the fund's net capital gains or losses are distributed on a per share basis as a capital gains distribution. You would expect turnover to produce more gains than losses. So the more turnover or higher the turnover ratio, the greater the capital gains distributions you can expect. Now, all mutual fund companies must offer a prospectus, which is a published statement detailing the fund's assets, liabilities, management personnel, and performance record. You'll want to make sure to take the time to read it and take a closer look at the fund's investments to make sure the fund will be compatible and appropriate with your investment goals. Here's an example of a prospectus here on the right. Now, mutual fund companies make this information readily available on their websites. So the prospectus is a great way to understand more about the fund's investment holdings, its historic returns, and the costs. And similar with rating agencies for bonds, there are mutual fund ratings in the financial media that you can also use as another source of information. Some of the rating agencies include Morningstar or publications like Barron's and Forbes. These all track, analyze, and report the performance of mutual funds. Now, beyond the scope of this chapter, there are some other investments that you might be interested in. There's real estate, whether it's direct or indirect. Direct could be if you're buying property, home, commercial, whereas indirect could be when you're investing in an entity who owns and manages real estate. One example of indirect investing could be a real estate investment trust or REIT, and that's a mutual fund of real estate holdings. It's a great way to, if you don't have a lot of money, but you want to invest in real estate, that you can buy an REIT and own a small portion of real estate. We've talked about commodities before, but you can also invest in agriculture, metals, energy, currencies. And then there's also gold, silver, and precious metals like diamonds and gems that you could invest in. There's also commodity indexes and exchange traded funds, which we've talked about. But commodities are risky investments, so just be careful if you're going to go that route. And another investment that you might already have in your home are collectibles, like sports cards, jerseys, or unique investments like artwork. Just note that collectibles and unique assets, while they may appreciate in value and act as a store of wealth, but there are disadvantages. They could be mispriced. Maybe there's nobody there to purchase it. It's not very liquid because there's no returns until you sell the asset. And then you also have to protect and maintain your collectibles in good shape. So that has a cost that you incur as well. So if you're interested in any of these, you could do additional research, but there's also an assignment for investment research where I offer some supplemental readings on these that are more current and up to date.